Hello, everyone. My name is Carmiana Matson. I am the Assistant Vice President of Regional Outreach and Public Programs at the Minneapolis Federal Reserve Bank. We're excited to welcome you today to our Conversations with the Fed event on achieving maximum employment. In a few minutes, I'm going to be turning it over to Terry Fitzgerald to talk to you about that. But first, let me let you know that we are going to be following up with all of you in an email later next week to give you a copy of Terry's slides for this presentation, as well as a copy of the video. And Terry will have time for some Q&A during this presentation. So if you have questions for Terry, you can use the chat box that's at the bottom of your Zoom screen. And if you type questions in the chat box, I will pose them to him verbally at the conclusion of his presentation. Also, at the end of this presentation, you'll be presented with an evaluation form. We'd love to get your feedback about this event, and we'd love to have you join us for future events. I'll be posting some links in the chat box on Zoom. We have two upcoming webinars on regional economic conditions, one on August 24th featuring general business conditions, and another on September 10th featuring conditions in the construction sector. So with that, I'm going to go ahead and turn it over to Terry.
Okay, well, welcome everyone. I'm Terry Fitzgerald. I'm Vice President and Assistant Director in the Research Division, and it's a pleasure to be able to talk with you today. I want to give a special welcome to my mom, who's watching, tuning in from Waterloo, Iowa. So, hi, Mom. So hopefully everybody who's tuning in realizes that the Federal Reserve serves the public by promoting a strong U.S. economy that works for all of us. We do that in many ways. We promote a safe and efficient payment system. We supervise and regulate banks and make sure that consumers are being treated fairly, and we support community development and reinvestment. But today, what I'm going to focus on is how the Fed uses monetary policy to promote a strong economy. So before I do that, I need to give a disclaimer. The views expressed are my own and not necessarily those of the Federal Reserve Bank of Minneapolis or the Federal Reserve System. Okay, so what I'm going to do is I'm going to start with discussing the Fed's goals that Congress gave us. One of those goals is maximum employment. I'm going to walk through a little bit about how we go about promoting maximum employment and who does that. Then we're going to look at some lessons we learned about promoting maximum employment from the Great Recession and the recovery from that, and how that experience really changed how we conduct policy, really. It was kind of a substantial framework change. And so we're going to kind of walk through that, and I'm going to tell you how we approach achieving maximum employment differently today, and then we'll look at the current economy. So that's the plan. Okay, so the Federal Reserve Act, so a congressional act mandates that the Federal Reserve conducts monetary policy, quote, so as to promote effectively the goals of maximum employment, stable prices, and moderate long-term interest rates. So that's what Congress instructs the Fed to do. Sometimes that's often referred to as a dual mandate, maximum employment and price stability. You might notice that there's three things above there. There's the long-term interest rates, but if we get maximum employment and we get price stability, then we get the long-term interest rates for free. So that's why we tend to focus just on the dual mandate is what's referred to as. Okay, so what is maximum employment? So Congress left it up to the Fed to define maximum employment and how we're going to pursue that. So the meaning isn't especially clear. It doesn't mean that we force people into labor camps. It doesn't mean that we require all kids to set up lemonade stands wherever they are. Loosely, what it means is the language is meant to say everyone who's willing to work should have the opportunity to do so. So we want a broad, inclusive labor force. Everybody who wants to get in should have the chance to do that. So that's the general comment. How does the Board of Governors define it? So the Board of Governors says maximum employment is the highest level of employment or the lowest level of unemployment that the economy can sustain while maintaining a stable inflation rate. So it's the highest sustainable employment that the economy can sustain without seeing inflation take off. So there's some difficulties right away with this definition. One is it's not directly measurable. So on our price stability mandate, there we have a directly measurable. We have an inflation measure, and we've said that 2% inflation is what we're shooting for. So it's a very specific goal. It's a target. Everybody knows the target. It's published by government sources, and that's easy to track how we're doing. This one is not measurable. It changes over time. It's influenced by a lot of factors outside the Fed's direct control. You know, population gets older. The education system may change. Tax policy may change. COVID or health situations may change. All those things change what the maximum employment we can have in the economy without seeing inflation take off. So how do we assess it? That's the big challenge, right? And that's what I'm going to discuss for most of the talk is how we kind of go about doing policy and how we try to achieve maximum employment. And I'm going to describe how that's evolved in important ways. So as we go along, I'm going to try an analogy to see if that helps people who maybe are a little less follow the Fed closely. So when I was a kid, my friends and I drove an old red VW Bug across the country. We'd go on trips and had a small engine in it. If we pushed the small engine too hard, the engine would overheat, and we had to pull over and stop and let the engine cool down. If we went too slow, of course, then you're just losing valuable time. So the problem is we didn't know how fast we could go, right? We didn't know what the highest sustainable speed was, how fast we could go without the engine overheating. And it wasn't a fixed speed, right? It depends on where you are. It depends on if you're driving in the desert or in a hot place. It depends on if you're climbing a mountain. For us, it depended if the wind was at our back and helped push the bug down the road. So all those things kind of made it difficult to gauge how fast we could go. So I want to say that idea of our maximum sustainable speed is kind of similar to maximum sustainable unemployment. You know, it can't be directly measured, that's sustainable unemployment. It changes over time, and you have to consider a bunch of factors. And by definition, you only know when you're past maximum employment when inflation starts persistently rising above it. We only know we've gone too fast in the VW when the temperature gauge starts rising up, right? And then one additional complication for policy is that monetary policy acts with a lag. So it's actually, our policies today go into effect a year or two later. And so we kind of have to look and see what the road's going to look like a mile or two down the road and try to adjust policy today for that. So that adds a degree of complication to try to do monetary policy. So that's the story. So I'm going to try to ride with that VW Bug example as we go along. So who decides? So who decides on monetary policy? So here's a picture of the main policy-making group. It's called the Federal Open Market Committee, the FOMC. So it's the body that decides on the appropriate monetary policy that's going to foster financial conditions that'll be consistent with the mandate, right? It's composed of governors that are appointed by the president and approved by the Senate. So if you can see my arrow here, Chair Powell is right about there. He's sitting on the right side of the table, about halfway back. Sitting next to him are some of the other governors, and then around the table are the 12 bank presidents. There's 12 districts with the Federal Reserve. It's a federated system, so the 12 bank presidents are around the table, along with various staff and research directors and people like that. So that's the group. They meet 8 times a year in Washington, D.C., and they decide on the appropriate monetary policy. So this picture was taken in 2019. So a while ago. Let me show you what the FOMC looks like today. So there's Chair Powell still. He's the only one still in the room. Everybody else is virtual on that monitor that's in front of him, and nobody else is there. So we hope sometime soon we'll be able to get back to in-person meetings, but not yet. And so we're still meeting virtually. Okay, so how do we pursue these goals? How is the Fed? What tools do we have to try to accomplish these goals? So we don't have any magic tools that allow us to raise the employment, raise inflation up and down directly, right? We have to work through the tools we have, and those mostly work through the financial system and interest rates. Keep in mind, fiscal policy, we're monetary policy, fiscal policy, government tax and spending policies, that's Congress, that's not the Federal Reserve. We do monetary policy. So here's our tools. I'm just going to briefly describe to you what they are. One of them is the first one is the federal funds rate. That's a very particular rate that banks charge each other on overnight loans. The reason that's important, it has a strong influence on short-term interest rates and then a little bit longer-term interest rates. And it influences the interest rates that consumers and businesses face as they make choices about investment and consumption. So that traditionally has been the most direct way that we try to influence the economy is with that federal funds rate. One shortcoming it is now is with interest rates so low, it reaches zero very quickly, right? It's like on a VW Bug, our gas pedal isn't very much off the floor. And if I step on it, I kind of get to the floor right away and I don't have any more juice there, right? I can't speed up more. As a result of that zero lower bound of hitting zero, we started using our balance sheet. So the second tool is this Federal Reserve balance sheet. So we can purchase longer term treasuries, longer term securities, and that's a way to push down directly on medium and longer term rates. So that's lower mortgage rates, lower investment rates for businesses. So some of you may recall that we did these asset purchases during the Great Recession, as a way to try to stimulate the economy further than just using the federal funds rate. And we continue to use that tool today. And finally, the Fed uses communication. So one of the ways the other way we can influence current interest rates is by signaling how it will change, how our policy will change as we go down the road. So what's policy going to look like next year and the year after that? So that's referred to as forward guidance. We influence rates through market expectations, and market expectations play a real prominent role in financial markets. And so that ends up being a tool that has some effect as well. So those are our three tools. I'm just going to give you a little quick picture here. So how do we use those tools to try to accomplish our goals? So this is just a little quick mnemonic that gives you the basic sense of it. The green arrow I'm going to start with. So let's start with that one. So when we want to boost the economy, like we have now, and like we have in the last year and a half, what we do is we lower the federal funds rate. That's at 0 now, and we promote a larger balance sheet. We do these purchases of assets, and we're currently do that. That's a way to lower interest rates. We try to promote investment and consumption, and that should push more jobs and higher inflation. So that's the mechanism, the way it's supposed to work. There's lots of complications to it, but that's the basic idea. Is we put our foot on the gas pedal of the VW bug. This big mountain appeared before us. We put our foot on the gas pedal, and we're trying to climb up this mountain and get the economy going as best we can to recover. Once we start getting to the top of the mountain, and we don't think we're there yet, but once we start getting there, then we'll do policy with the yellow arrows. We'll start slowing down. We'll lift our foot off the gas pedal. And we hope to do it in a very kind of gradual way, so that the federal funds rate will come up. We'll stop buying long-term. We'll stop buying assets. Eventually we could shrink them, but we'll stop buying them. And we'll try to ease our way into reaching the top of the hill, and then hopefully getting to a flat part where the VW bug goes down the road, and we're at sustainable speed, and we're going as fast as we can without overheating. So the trick of this is to try to ease off the accelerator, and try to just do it gradually when you get to the top of the hill, so that you keep some speed going as best you can. That's the plan. The problem is, it's like I said, it acts with a lag, so we can't see a mile or two down the road. And if we miss, we might brake too soon, or we might, or it might come up too fast, and we're accelerating too much. So that's kind of the idea of the challenge. Okay, so there we are. So that's just kind of the background. I'm going to stop for a second here and see if we have any questions. Somebody did ask me how does the Fed set a target interest rate? Is the goal to stimulate spending on the assumption that prices will increase? So how do we set the target inflation rate? I mean, the idea of that was, so it's 2% is the inflation target. So that was decided, I can't remember exactly, 12 or 15 years ago, 20 years ago, people decided you don't want too little inflation. So sometimes people think we should do 0. You don't want too little, because we think the economy doesn't perform well. So Japan has been stuck at 0 inflation for a couple of decades. We think that hasn't helped the Japanese economy perform. A little bit of inflation is useful for kind of keeping the economy rolling forward. The question is how much inflation, and 2% was what we decided on then. I don't think there's anything particularly magical about 2%. We could have decided on 3%, but we decided on 2. And then once we decided on 2%, we wanted to stick with that. So I'm gonna move on that, and then we'll come back. And when I go through the other things, we can come back in Q&A, and I see more questions coming in. We'll pick them up there. So I'm gonna go on to the lessons from the Great Recession. So the financial crisis hit in 2008. That led to this huge recession, 8.7 million jobs, and the Fed responded very strongly. So range of tools. What I'm going to do is I'm going to talk specifically about how the Fed adjusted its policy to promote maximum employment as the economy recovered. So I want to just stick on this maximum employment angle. So a lot of things happened, and I'm going to talk about that. And in particular, at the time, the unemployment rate was really the statistic of most interest. So people focused, as a way of getting a sense of maximum employment, people kind of looked a lot just at this single statistic, the unemployment rate. And it was widely used as a key indicator of how close the Fed was to achieving maximum employment. So that's what I'm going to focus on in the talk. Okay, so I'm going to kind of walk through quickly what happened here. So the recession hits in the end of 2007, 2008. The shaded area in these charts is the recession. And you see unemployment rate starting to rise. It rises to 6.8 by December of 2008. At that point, the Fed has reacted, and we've set the federal funds rate to 0. So we see the big mountain just suddenly appeared before us. We're stepping on the gas pedal to get the federal funds rate to zero to see if we can help promote growth in the economy and to slow the job loss. We also start asset purchases about then to further use other tools just to sort of see if we can slow the disaster that's happening to the economy. So that happens at first. And then what happens in the next few years? Well, I'm going to stick with that blue line, the unemployment rate. It peaks at 10%, and then it steadily comes down. And I stopped it here at December 2015. And I'm going to tell you why in a second, but it comes down to 5.1%. Let me tell you about that orange line, because that's an important line. So the orange line is a proxy for maximum employment. How fast can we have the pug go? How many jobs can we get before we're going to overheat the economy? And starting in 2009, the FOMC participants were asked 4 times per year what they thought the unemployment rate would be in the longer run. So when the economy settled down and we were at 2% inflation, what would the unemployment rate be down the road? And by December 2015, they thought it would be 4.9%. So that's where we think we're going to get to max employment. And you can see we're getting close then, right? We're getting close to the point where we think we're going to be above max employment, and then the economy might start to overheat. That idea is often referred to as a Phillips curve, where if the unemployment rate gets too low, labor market gets too hot, you're going to see inflation take off. So in December 2015, we got the unemployment rate of 5.1, and we think we're getting close because the maximum employment estimate is 4.9. I'm going to draw a line at 4.9 just to remind you that that's what they thought maximum employment was at that time. So you might wonder if inflation was rising at this time, then that would create concerns, right? If inflation was taking off, then you might think, well, we got to be worried about the inflation part of our mandate, and we might be approaching maximum employment if inflation's heating up. In fact, inflation wasn't heating up. So here's the picture of what inflation is doing. So these are the 2 measures of inflation. The blue line is PCE, headline inflation. That's the measure that the official Fed measure that the Fed uses to gauge inflation and to look at our goal. The orange line is called core inflation. So we take out energy and food, not because energy and food aren't important, they are important, but because they're volatile. They bounce around a lot, and they don't really give you a good impression of where underlying inflation is going. So, for example, you can see in 2008, it was actually oil prices that shot way up, and headline inflation was 4%. But oil prices bounce around a lot. And even though they shoot up, you don't expect them to continue to shoot up. And in fact, it did reverse, you can see there. So, in 2008, when headline inflation shot up, there wasn't a big call for, the Fed is the inflation mandate, we're losing control, we need to tighten policy. That would have been a mistake. That price increase was transitory. And the orange line helps you see that a little bit. The core says, no, that's just about energy and that's just about those things. It doesn't look like inflation's taken off, but that's going to be a useful example for us to come back to. Sometimes headline takes off for transient reasons, inflation does. You don't necessarily want to react to that if it's not affecting underlying inflation. So inflation wasn't getting too low. Inflation expectations weren't rising, so there really wasn't a signal that expectations were rising. It really was the concern was the unemployment rate was going to get too low and that inflation would rise above 2%. Okay, so what happened? We know the unemployment rate fell a lot further. It actually ended up falling to 3.5% right before the COVID recession. To the FOMC's credit, they saw the unemployment rate was falling, and they saw that their earlier estimates of maximum employment were the participants saw that it was high, and they kept bringing it down. The participants kept bringing their estimates down. So that was, they did that, but at the same time, they were tightening policy. They were lifting their foot off the gas pedal. They were accelerating. They were stopping the asset purchases and slowing down. And they probably tightened a little too much because they were misjudging where maximum employment was. They slowed the car down. We were driving our bug. We thought we were getting to the top of the hill and we were going to shoot over, and we weren't quite, because we thought we had a good indicator of it, this maximum employment, but it turns out it was kind of a false indicator. And so we slowed down really before we probably should have. And even though we kind of kept it going a little bit, we misjudged where maximum employment was, and we probably lost some jobs. Let me show you what the jobs give you this counterfactual. So back in 2015, we thought the unemployment rate, as low as it could go, would be about 20. People thought the low it could go would be about 4.9%. If we'd have been insistent that we not allow the unemployment rate to go below 4.9%, that would have left about 2.5 to 5 million jobs out that eventually came on. So, the fact that we kind of misjudged it, it was good that the committee realized that they had misjudged it and let it sink lower. So that was a good thing. But not only did people in the labor force get jobs that were looking for jobs, we also continue to have more people from outside of the labor force. So the way the unemployment rate works is you have to be actively looking to count as being in the labor force. So a lot of those people found jobs, and then a lot of people that were outside of the labor force also came on, and they were disproportionately lower wage workers, less skilled workers, lower educated workers who found opportunity in the economy as it kept growing, and came into the labor markets in a way that was extremely positive and beneficial. So that's what happened. Probably we tightened a little too soon. We probably could have brought in a few more people on, but still the economy was healthy at that point. So let me show you what happened to inflation. So you can see it did come back. So inflation did come back from 2015. It came back toward 2%, but you can see it never really got above 2%. It kind of stayed there. In 28, the blue line did go up 18, a little bit above 2%, but then it fell back down below. So, if you look at the 2% target and that black line, we were persistently below 2% for this entire period. For 2012 on, when they put the 2% explicit target on, we've been persistently low. One reason for that was the policy then was to try to just get back to 2%. So the idea was just move it to 2% and just shoot for just reaching 2%. You shouldn't try to make up the past low inflation. You should just try to get it back to 2%. And so you can see we kept trying to get it back to 2%, and we touched it for a little bit, but it stays persistently low, and it looks like 2% is a ceiling. That doesn't look like a symmetric. That's not averaging 2%. It's not a symmetric target. And so underlying inflation, so markets started expecting, well, it's going to average about 1.8%. And that was starting to get built into behavior that, well, on average, it's going to touch 2%, but it's going to stay low. So that was one result was that we started staying too low, and then we underachieved on both the price and the maximum employment mandate. We could have pushed the VW bug a little bit harder. We could have accelerated more. We didn't. We ended up actually being too low on the price mandate and on the employment mandate. So that's what we're going to talk about, what we learned. So what we learned, the key lesson we learned from the Great Recession was that we relied too heavily on maximum employment in judging what policy should be. And that led to, inappropriately, we tightened policy more than we should have. And there were fewer jobs and below target inflation. So that was the takeaway. And in 2019, the Federal Reserve launched a comprehensive and public review of monetary policy framework. So our strategy, our tools, our communication, how we achieve these mandated goals, we decided to review it, see what lessons we learned. There was one of the lessons, and how we could improve the framework to more effectively achieve our dual mandate goals. So we went out and we did 14 Fed Listens events. So we went into communities all across the country and listened to what their experiences in labor markets, their experiences with the economy, and what they thought of the Fed and Fed policy. And one of the things we persistently heard was that unemployment, while it was low in the nation, there was large pockets of the economies where the unemployment rate was still high, and they were still looking for people looking for opportunities to work, particularly in disadvantaged areas, in low income areas, where people did want to get back in the labor force. And in fact, we saw them do just that. For 2015 to 2019, we saw more people pull back in. So as a result of that review and academic research, we made three changes to the framework, three really pretty important changes. One was about inflation. So I showed you that inflation was persistently below 2% for 2012 to 20. So a long time it's too low. So our new framework emphasized that we should average 2%. Not that we should target inflation, but we should target average inflation. So rather than just trying to get back to 2%, we should try to overshoot. If unemployment's been low for a while, we should allow it to overshoot moderately 2% so that it averages 2% over time. So that wasn't what we were done previously. Previously, we were trying to let off the gas pedal, the VW bug, so that we ease in and we never let the temperature gauge raise much. And we just try to get there to the top of the hill. Now we're saying, no, it's okay to kind of keep your foot on the accelerator. And if the temperature gauge raises a little bit, that's okay. We can go a little bit faster and then bring it back down. That allows us to keep our foot on the accelerator a little bit more, both to raise inflation and to create more job opportunities. So that's an important change that's going to allow the Fed to be a little more accommodative, to actually achieve our dual mandate, to average 2% rather than being persistently below, and to bring as many people on and create as many job opportunities as we can while hitting that inflation mandate. So that's the first major change. The second one is that policy be informed by shortfalls and not deviation. So by that, what you mean is, before there was this concern that we were overshooting employment, that the unemployment rate was getting too low. And in the new regime, we're not going to be concerned about that. We're not going to slow the economy solely because we think we're past maximum employment. So that's a deviation, that we're too low and too high. We might adjust. Now we're only going to adjust that when we're short, and when unemployment rate gets low, we're not going to use that exclusively to slow policy. We're going to keep policy going until we see signals from prices or wages or something else that tells us we're overheating. So we don't want to prematurely overheat. So keep our foot on the gas cellar longer and wait to see that temperature gauge raise up. And the third major change is really thinking about maximum employment more broadly, not just as an unemployment rate and an aggregate statistic, but really to look at a whole range of statistics. People are having very different labor market experiences throughout the economy by wage level, by education level, by race and ethnicity, by geography, rural, urban. So lots of different experiences out there. And it's critical that we look at a range of statistics to help us understand everybody's experience and get a comprehensive look at what maximum employment is. So that's part of our mission too. So that's the big changes. Now let's talk about the current economy and wrap up on that. So we're pursuing maximum employment. So where are we now? Okay, so one place we are right now is we're still about 7.5 million jobs below where we thought we would have been if COVID hadn't hit. So I told you the Great Recession was a huge recession. That there at the peak we lost 8.7 million jobs. Here we're still almost a Great Recession down from where we thought we would be. You see, immediately we lost 23 million jobs right out of the chutes. Those first few months, that's just historically unprecedented. There's nothing close to that kind of a shutdown. Now, some of it was the government. Some of it we shut businesses down and told people not to go to work. And a lot of it was just fears of COVID. We didn't know what was going on, and people were just staying home. You can see that early on, people did recover. There was a recovery. People went up pretty quickly right there in that early page. People went back to work. Millions of people did. But then that slowed down again in the winter when we had another wave, and job markets are picking up again now, but we're still 7.5 million down. So there's lots of untapped labor supply that's out there. I'm going to talk about the unemployment rate for a second. So we talked about the unemployment rate before. I indicated this was not a very good measure. I'm going to tell you a couple of reasons why. It peaked at about 15%, 14.8 in April 2020. It's now down to 5.4. The problem with the measure is it ignores millions of people who leave the labor force and then are not actively looking for work. So it's not success for the unemployment rate if the reason the unemployment rate goes down because people quit looking for work. That's one reason the unemployment rate can go down. That's not a successful economy. If you add back in the people who left the labor force and that were working previously, then you get a number closer to 8%. So, it's important to keep that in mind when you look at the unemployment rate. I saw this morning the Minnesota unemployment rate came in at 3.9%. Now that's a remarkably low rate, but it has the same problem. There's 100 to 200,000 people that have left the labor force that aren't being counted as unemployed. So that's a deceptive statistic in thinking how well the economy's doing. So you want to keep that in mind. The other reason it's deceptive is because there's lots of different labor markets experiences that are going on there. I'm just going to show you a couple of examples. So if you look at the unemployment rate by race and ethnicity, you see that the orange line there is Black and the black line there is Hispanic, Latin, and Latin American. You see that those unemployment rates went up a lot, and they had the peak unemployment rates during COVID, and they're still much higher. They actually were much higher, and they remain much higher. But those groups got hit particularly hard in COVID, and they're higher in general. So there's very different labor market experiences, and it depends a lot on there, even by age, what you look at. So people are having different experiences there. And if I look at by education, you can see people having vastly different experiences by education. And it's not surprising. If you look at the green line at the bottom, that's the bachelor's degree and higher folks. Yep, unemployment rate went up for everybody, but it didn't go up nearly as much for college educated people. Much more likely to be able to work virtually, to keep their jobs, and it's still down to 3.1 now. If you look at the less educated people, you see those unemployment rates went up much more, and they remain extremely elevated. And that's why, that's one of the things economists will talk a lot about, and the president of our bank and our Minneapolis Fed, we talk a lot about education. We have various initiatives on education. We've supported early childhood development as a high return investment that, especially when it's targeted to at-risk kids, that's a way to kind of promote education and get more people effectively in the labor force with good opportunities. So that's part of maximum employment. Right now our bank president with Chief Justice Alan Page has also got a constitutional amendment in Minnesota to guarantee a high quality public education for all kids. So, we think education is really a key for achieving maximum employment and everybody having an opportunity to succeed in this economy. And so that's one of our cornerstones of the Minneapolis Fed. Let me show you one last picture that really kind of hits you over the head with how the disparate impact of the groups has been. So this shows you the change in the employment by wages. That green line, the top line, is people making $60,000 a year. So that's not extremely high wage. I don't think it's a nice wage, but it's not high. And the blue line on the bottom is 27,000. And what you see is all the groups took a little bit of hit at first, although low wage workers massively bigger hit. The other groups have basically recovered. So the higher wage, medium wage workers, they're basically back from where they were in terms of employment. The low wage workers aren't. So they came back originally, but now it's been flat, right? And we know that is. That's leisure and hospitality workers, that's service workers, that's people with face-to-face contact. They're not being pulled back in yet. So there looks like there's still a lot of labor supply out there. Now, I'm not looking at my chat box right now, but I can be almost assured that there's a lot of people screaming, well, what about the fact that businesses can't find workers, right? There's all this supply out there. What's going on with the lack of ability to get these workers? And we see that everywhere. There's anecdotes. We have a Minnesota State Fair coming up. They're struggling to find enough workers to man those booths and to work our state fair. You see it wherever you go. You drive on the roads, restaurants, all kinds of places. Firms, plants can't find, especially these entry-level workers, right? So what's going on? Why is it there seems to be so much supply of worker out there, and yet we can't find these workers? So that's what I want to kind of conclude with that. Well, there's the job openings level. So that's, again, showing you a huge number of job openings. All kinds of jobs are out there. Okay, so what's going on? So basically, I think what's going on is labor demand is increasing very, very fast, and it's outpacing the return of labor supply. So what we're seeing is in the first half of the year, we've seen consumer spending grow much faster. It's a historic pace. It's incredibly fast how quickly the economy opened up in the first half of the year, right? Vaccinations came online. That was encouraging. Lots of fiscal support, unprecedented fiscal support to keep people going. And monetary policy was also accommodative. So we had this huge support. The vaccinations, people have been holding back. They had savings that they hadn't spent. They had fiscal support, and we started spending a lot. And especially we saw that in durable goods, in all kinds of areas where people are spending like crazy. And I think we all have our stories of, you can't get appliances. You're waiting for appliances to come in. Cars are expensive. You can't get a bicycle. We try to buy a bicycle and you can't get a bicycle. There's all kinds of goods because of the surging demand that's happened. And at the same time, supply is being restricted worldwide because COVID is one of the factors. Besides trying to ramp up production, it's breaking supply links because other countries are suffering much more than the U.S. is in their COVID experience, and that's also disrupting supply chains. So we got this huge push that's a little bit constrained by supply constraints. The labor supply just isn't coming back as fast, right? Why is that? Well, we don't know for sure, but a variety of these factors seem likely to be part of it. still fears. There's still a bunch of people that are worried about going back and being in contact with people. There's caregiving issues. There's daycare. It's hard to find daycare. It's schools not being in person. So hopefully soon the schools will be back, right? But that's been a big constraint for parents. UI benefits. So there's a question of UI benefits are going to roll off here in just a few weeks. Millions of people are on these pandemic programs and are getting the top off $300. Those will roll off, and that might also encourage more labor supply to come back. And then there's restructuring going on. So early on, people just went back to their old jobs. Now it's not so much now that people are just going back to their jobs. The economy's restructuring with what's happened, and people are having to form new matches with firms. Firms and workers are having to match. So you're having to find a new place to work, maybe a new industry to work in. That takes more time to match, so that kind of slows the process down a little bit. So all those things are slowing down, along with some early retirements. Right now, the expectation is those supply constraints are going to continue to ease in the coming months. So we should see, we're hoping in September, schools come back online. Daycares hopefully pick up and people come back into there, in part because the UI benefits, a lot of them are going to expire, and that should encourage some people to get back in the labor force and work at some of these jobs. So we think in the fall, those things should help ease the labor supply. So hopefully these, all the help wanted signs we're seeing and the difficulties of getting labor, that should be eased. That's not to say you're going to easily find workers again for $12 an hour. It depends on what area of the country you're in. It may be that low wage workers' wages have gone up permanently. And, that's a good thing. That's higher wages for people that need it. But we think it'll be eased. We think the pressure on the wage growth will be eased, and there'll be more people coming in line. The last 2 months, we've seen almost 2 million people come back on. We expect to see strong employment growth through the end of the year. So more and more people come on. It takes a little bit of time, but that should help offset this imbalance we're seeing right now between this huge tap of unreserved labor supply and this incredible crush for labor demand to get these products out. So the final couple things I want to talk about is us prices, is wages and inflation. So, if you're thinking about maximum employment, one obvious place to look is if the economy is overheating, if labor markets are too hot, you should see that in wages. And in fact, Chair Powell had a famous quote, back in 2018 or 2019, where people were talking about hot labor markets. Even then, talking about hot labor markets, and he said to call something hot, you need to see some heat. Are we seeing wages increase? And it's true we're seeing them increase at that entry-level job that we've talked about. Those entry-level workers are hard to get. But if we look across all the jobs in aggregate, we're still not seeing that strong a wage pressure. So here's a couple of measures that are good measures to look at, especially the blue line. It's the employment cost index. It includes benefits. And it also, importantly, it makes an adjustment for the composition of workers. So, one of the things we've talked about is how disproportionate the impact of COVID has been. So that means that people coming in and out of the labor force are very different types of workers. So, of course, if all the low-wage workers leave, average wages go up because you just have the high-wage workers there. And so you have to make an adjustment. And that's what this employment cost index does. And you can see in the blue line right there at the very end, it has tipped up a little bit, but not much. It's still relatively low. And the orange line out of the Atlanta Fed is another similar kind of measure that adjusts for composition. So they're not that strong. Even though we're seeing this strong wage growth at the low end of the wage distribution, overall, we're not seeing it. So that's not putting that much pressure. In fact, it'd be good if wages went up, especially if productivity continues to increase, then that's part of wage growth, and you can see stronger wage growth without seeing inflation. So, if we have a more productive economy, wages can go up. That doesn't necessarily mean inflation. Right now, we're not really seeing in the wage numbers anything that looks like a major concern, but we're monitoring that. Now, finally, inflation. That's probably why some people tuned in. So here's the picture of inflation. Again, the blue line's headline, the orange is core. So everybody's aware it's gone up, really popped up in the last 3 or 4 months. So the inflation numbers are really popping up. That's the solid blue line and the solid orange line. So it's moved up to 4% in the blue line, and the orange line is 3.5%. So those have moved up a lot. So what are the dashed lines? The dashed lines are what professional forecasters think is going to be the path of inflation as we go forward. So these are the geeks that kind of look at this stuff carefully and they make their forecasts. And they see it coming back down to close to 2% at the end of 2022. So they see this as transitory, as coming back down. And that's, forecasters have a range of views. So not all forecasters think that, but that's what most of them, that's the middle range of forecasters. Some think higher, some think lower. If you look at financial markets, if you look at things like long-term interest rates, if you look at mortgage rates, those are also not pricing in a big rise in inflation. Financial markets, that you can also back out expected inflation from financial markets, from things like TIPS, these treasury inflation protected treasuries. You can back out what markets think inflation expectation is. And while in the short run, it's expected to move up just like it is, in the longer run, there really isn't any movement. So why is that? So why is it that the forecasters and the markets and the FOMC and the Fed thinks these recent inflation jump is going to be transitory? Well, it's because the increases are coming in a very narrow set of prices that are very specifically related to this reopening, to the historic reopening and to the supply constraints we're seeing that associated with the reopening. So the next chart is going to kind of give you the example, and I think your own experience is going to kind of match with that. So this chart shows you, so core CPI inflation. So this is showing what one of the inflation measures, and it shows you the monthly data that comes out. And you can see in this area right here, the big inflation numbers that start coming out, right? So they're popping. They're really going up a lot. So where is that coming from? What this chart does is it breaks down where the increases are coming from. So that red part, which is a big part of it, right? That's vehicle related. So that's about new cars, used cars, and rental cars. So I'm going to guess that a lot of you are having the same experience that me and my friends and family are, is used cars have gotten very expensive. The used car data says used car prices have gone up like crazy. Now, I sold my used car right at the beginning of COVID, so that was a mistake. Should have seen that coming, but nope, used cars went up a lot. Rental cars are also up dramatically. If you're trying to take a trip or a vacation, rental car prices are high and new car prices are high. So that's all related to a backlog in orders. Partly they slowed down auto production more than they wish they would have back in 2020. They didn't see the surge coming. And now there's a little bit of a log jam with semiconductors. And so they're trying to surge production, but semiconductors are slowing their ability to do that. That one's going to take a little bit of time to adjust, but they're ramping up production, and they'll continue to ramp it up. And by next year, it'll be steadily ramping up a little bit. So that's a big chunk of it, is the vehicle related. The blue lines you see there at the top of it is that's pandemic affected services. So think of that as vacations. So the two areas are vehicles and vacations. So that's hotel rates, that's airfare, and that's admissions. So, right, what happened is almost mathematically, right, hotels and airfares got really cheap last year. It was very affordable to fly or to go to a hotel in the middle of the worst of the pandemic. Prices are coming back. And so, of course, you're seeing inflation when the hotel prices come back. In a lot of areas, hotels and airfares, they're kind of back, getting close to where they were pre-COVID. So you're going to see a boom in those. That doesn't mean they're going to steadily increase, right? Just like with the cars, used car prices aren't going to continue to go up. They're likely to come down, and there's some indication that they're starting to come down now. So those two things both look transitory. They've accounted for most of the recent increase, and they're expected to level off. And some of them may even reverse next year, right? Used car prices are expected to come down because they're really high right now. An example of that is like lumber prices in the construction industry. I mean, lumber prices skyrocketed. They went from $500 per 1,000 board feet. They went up to $1,700. And now when I looked this morning, it's back under 500. So those supply constraints happen. And then the production needs to respond to that. Some production can respond quicker than others, but that's why people think it's going to be transitory. It could take a few more months. For some, it could take several months to kind of get that back online. But it doesn't look like a persistent. We don't think used cars are going to keep going up and up in prices, and airfare is going to keep up and up in prices. The prices may level off at different places, but that's what's going on. So that's the expectation. Now with all that said, it's got our attention. I mean, those jumps were a little higher than we thought, and so the Fed is closely monitoring what's going on with inflation and watching whether this bleeds out into something more persistent than we're expecting. If it does that, then the Fed will have to respond to that. But right now it looks like transitory. And what you don't want to do is take your foot off the gas of the bug if in fact we're not there yet, right? And it's a little bit like I showed you in 2008, the inflation numbers went up. We didn't want to tap on the brakes in 2008 because oil prices went up, because then we'd have been tapping on the brakes at the same time the economy was collapsing, right? We don't know what's going on here. You don't really want to start tapping on the brakes with transient, because we're going to keep people from entering the job market that we want to get back in. There's still a lot of people that need to come back in. So we want to promote that as long as we can while being mindful of it. So that's what's going on there. We're going to be monitoring that closely. That's it. What are the takeaways? Here's the last slide. So the takeaways are, the Fed has a dual mandate. That's what you need to know about us. Congress told us what to do. We're trying to pursue maximum employment, create as many job opportunities for as many people who want them as they can, while keeping prices stable at 2%. We've adjusted that framework over time. So we're trying to think about the lessons we learned. These have been an amazing 15-year, very difficult, trying time for lots of people. And we're trying to figure out how to be more effective in doing the job that Congress gave us, in promoting job growth and hitting that 2% average inflation. And so what we do is we're going to continue to use all the tools that we have to support a strong recovery in support of that, in pursuing that dual mandate. So that's what I have to say. I know that was quite a bit to get through, but I'm gonna stop sharing now, and we can open it up to Q&A.
All right, if folks have questions for Terry, you can type those in the chat box on Zoom. And Terry, could we just start with a couple of basic monetary policy questions? Can you give us a little bit more information about why don't we want inflation to just be zero?
Yeah, so that's a great question. Historically, that would have been something we would have thought was a good idea. There's some theory that says that, but there's something about a little bit of inflation that helps the economy perform better. So just as an example, we're a little bit concerned. Japan has had zero inflation for a couple of decades. Its economy hasn't performed very well. And so there's a little concern that part of it could be the zero inflation. A little bit of price increase helps the economy kind of flow along. For example, wages sometimes need to adjust as the economy shifts, and we may see some of that now, right? Some wages will go up and wages will go down a little bit. With a little bit of inflation, you can adjust wages slowly without cutting pay. It's difficult for people to get a pay cut. When there's a little bit of inflation, there's 2% inflation, wages can go up by 1%, and that feels okay. It feels bad to cut wages for people. Like, I'm worse less this year than next year. And that wage process kind of matters a lot because there's lots of churning going on in the economy. And so a little bit of inflation helps kind of smooth that labor process from moving on. The key about it is it's really the 2%. It's consistent, as consistent as we make it, that underlying inflation. We don't want it to be, -5.7, -5.7. We want it to kind of be smooth. People can go about their business and not have to worry about inflation as part of their everyday business. It's just 2% is low enough to where you don't have to worry that if you have a $20 bill in your wallet next month, it's just not going to be worth anything. So that's basically the idea. A little bit of inflation is good for the economy, but you don't want too much.
Great, thank you. Also, a couple more basic questions. You had mentioned that one of the tools that the Fed has to control interest rates is asset purchases. Someone is wondering, what kinds of assets do we purchase?
Yep. So we mostly purchase treasuries and mortgage-backed securities, which are also backed by the Treasury. So we're just producing the safest, the Treasury securities that the U.S. government puts out. So we're not purchasing stock or equity or private company stocks. It's U.S. Treasuries, because we don't want to weigh in on private business and private corporations. The Treasury market is huge, so it's a market that we can weigh in on and not have be disrupting into the private sector financial market flow. So it's mostly treasuries. That's what we hold in the portfolio. We hold a lot of them.
There was also a question about, how do we know when we're in a recession? Who determines that? What is the criteria? Are we in one right now?
Yeah, so there is actually an official group called the National Bureau of Economic Research that decides it. But I think the easiest way to see it is to look at the jobs. A recession, when the unemployment rate starts going up, when people start losing their jobs more than they're getting jobs, and we see that unemployment rate going up, and you see it going up across, that's what a recession is when the unemployment, and if you look at the unemployment rate statistics, that's what you'll see is when it starts to climb, you're in a recession. People are losing their jobs more than they're getting them. So that's when it starts. Now, when does it end? Usually people think it ends when the slide stops and the pickup begins. So in this case, this is a pretty dramatic one. So it's pretty clear. We peaked in February, and then March, the news came in on COVID, and the job loss, boom, 6 weeks, we lost 22.5 million jobs. By April, people were starting to come back, right? So, they call that the end of the recession. We're still in a depressed economy. We still have all these jobs that are lost, but we're climbing our way out of it. And so, it just depends on what terms you use. By the NBR recession terms, we're no longer in a recession, but that doesn't mean the economy is not depressed. It's growing, so that it's not a recession in the sense that it's growing. But we had a long way to grow. We had 22.5 million people lose their jobs. We got a lot of work to do to get back. Just like in the Great Recession, it took 8 or 10 years to get people back in there. So just because we're not in a recession doesn't mean we're not depressed in economic activity and trying to build our way back in. So that's it's really about jobs and people. I think in the end, that's what recessions and stuff are. It's not some technical magical things. It's about jobs and people. Are people losing their jobs and becoming disengaged? And then are they getting their jobs back and have an opportunity?
Thanks. Let's switch gears a little bit here. There was a question about housing prices, and that's not part of what we're looking at with inflation, yet the interest rate plays a role there. Can you talk a little bit about housing?
Yeah. So we split goods up into so when we do inflation, we're looking at goods that people are consuming, goods and services that people consume versus investments. And housing is viewed as an investment. So housing prices themselves don't get calculated in. That's an investment good. What gets counted is the rents from housing or the implicit rents from housing. It's about rents. And then it's kind of a complicated formula that the government uses, that the Bureau uses to calculate what the implied rent is for owner-occupied housing. So that's a big sector. So it's not the prices, but the prices will feed into the rents. And it's the rents themselves that will feed into inflation. So, we don't have assets. We don't have assets in these prices. We don't have houses in there. We don't have stocks in there. It's about what we're consuming. And, when you buy a house, what you're really consuming is the flow of services that house provides. And that's in rents. And so we measure that, in the rental market, and then we do another kind of a calculation for people in homes. So, while the home prices themselves hasn't gotten fed into it, rental prices will, and that's part of the conversation is, are we going to see rents start to go a lot, rental prices go up a lot? And so, that'll be part of how we see inflation unfold in the future. But that's what goes on with house prices.
There was a question about whether Reserve Bank presidents coordinate their public statements about the timing and the direction of policy changes. How does that all work?
Yeah. Well, no, if you're enough of a Fed groupie to watch them, you can kind of tell they're not coordinating the statements, because Fed presidents, it's a good thing about the Fed system. If I don't know, I don't think most people this is too inside baseball. Most people aren't paying attention, but if you went back and tracked what Fed presidents are saying, there's a lot of views being expressed and a lot of different views. This is a complicated process to figure out what appropriate monetary policy is. And so it's not easy to come up with an answer, and people have very different perspectives on what that is. And you'll hear those from different Fed presidents. So, there's not a, I think that's a good thing, right? If we were in, the old Soviet Union and there was a Politburo, there was one message, and everybody stuck with the one message. We don't have that. We have lots of dissenting voices, and Chair Powell's job is to listen to all those dissenting voices and collectively to use the wisdom of the group to kind of come up with a policy that's going to work to promote our goals. So no, there's no coordination going on. There's these people have strong views. They're very independent. They're very independently minded. Those of you who have seen our President Kashkari, he's not coordinating with anybody. He's saying what he thinks. He's saying what he thinks is best for the Fed, what he thinks is best for the country, and that's a good thing. And then they have these discussions and they have the disagreements, and we try to decide what the best policy is going forward.
There are a couple of questions about the unemployment statistics. One person questioning, why don't we just look at workforce participation rates versus unemployment rates?
Yeah, and we do. I already used a lot of time in the talk. So there is a million kind of statistics in the labor markets, and more and more we're looking at a lot of them. The one I didn't show you is a popular one you'll see is just the employment to population ratios. What fraction of people are actually working? And then that gets rid of the question of Are they looking for a job? Are they not looking for a job? Just, you're 25 to 54 years old. That's called prime age, which irritates me a little bit because I'm older than 54. So I feel prime, but I'm not. If people just, what fraction of those, and that number is way down. So, I mean, that's the kind of thing, like if you looked at that in Minnesota, I just told you the unemployment rate was 3.9. That looks really low. If you looked at the employment to population share, it's still way down from what it was. It's still notably down from what it was before. So people look at those shares, but there's lots of factors. There's also the factor of, are you working part-time or full-time? How do you count those people? We have different measures for that. We have different measures for, lots of different sectors of the economy. How are we doing rural? How are we doing cities? How are different groups doing? How quickly are people getting back to work? How are the long-term unemployed doing versus the short-term unemployed? How are the people of different education levels? How are we doing a pulling them back in the labor market? So there really is a bunch of statistics. The unemployment rate is an informative tool about how it's going. It's just, there's lots of action. There's just lots of disparate experiences that are happening, and people are paying very close attention to them now. So that is all happening in the background. It's just a lot to go through.
And Terry, can you talk about how the gig economy factors in here? Those folks who are maybe doing Uber or Lyft or DoorDash.
So the gig economy, I mean, on the unemployment rate, the unemployment rate's calculated by, that's just a survey of households that the government does. So they're going to count if they say they're employed. You answer questions whether am I employed, am I working for, so if you're employed if you say you're employed as an Uber driver, that's going to count as employed. So they're going to count in the unemployment rate and in the employed. They're self-employed, so there's a category for self-employed. They did play a special role in this one because, what was interesting, one of the things about the gig economy was they didn't typically qualify for UI benefits. And one of the programs allowed gig workers and other workers in their area that wouldn't normally qualify for UI benefits. So, that's another area that those benefits are going to end in September, and the special program that applied to gig workers is going to roll off in early September. So, for people that like to use Uber, I don't know how much we have that in the 9th district. It gets people in the cities, but in the big cities, there has been kind of a noticeable shortage of Uber drivers, and so some of those goes back. But yep, their worker counted. They're kind of special because they're self-employed, and self-employed workers have their own. We had to keep track of them kind of separately because they're not on payrolls. But yep, they're all part of it, and yeah.
We'll have time for one last question, Terry. Can you tell us, do we have any insights into the folks who have left the labor market? They say they're not currently searching for work. Do we know who those people are?
Yeah, so we have statistics kind of that let you know where the labor force is down. It's really across the board, but it's disproportionately lower educated, lower wage workers. Educated people tend to not move out of the labor force, right? You invested to get educated. You tend to stick at it, and some people leave and some people do some other things, but they tend to be stickier because your spousal relationship, whatever, it's people come and go. Lower wage, lower educated people, they're more likely to kind of come in and come out. We think those are the people that are the data shows us that they're the people that are more on the sidelines. That's what happened in the Great Recession. One of the things that happened, I got to tip my cap to our President Kashkari. He was calling for this. People thought maybe we were at maximum employment when it was at 4.9, and he was saying, well, I want to see inflation. I want to see that we're there because I want to bring as many people on as we can. We brought on another 3 to 5 million people, and they were disproportionately lower educated, lower wage, marginalized people who, it's tough, and they were just looking for an opportunity. They need the economy to be functioning well and providing opportunity for them because they got struggles in their lives and they want opportunities. People do want to work. That's always our baseline assumption is people want to go back to work. So the economy needs to work well to pull as many of those people back in. So it's disproportionately those people that we're trying to get in.
Great. Thank you so much, Terry. Thank you to all of you for joining us today. We appreciate you being here. We will be following up with all of you with an email next week with a link to Terry's video as well as a copy of his slides. As you close out on this Zoom, we'd love to have you fill out our evaluation form. Let us know what you thought of this event. And I've included a couple of links in the chat box on Zoom for our next upcoming events. Thanks so much, everyone. Have a great day.
Thank you. It was a pleasure.